Hey everyone, I'm Clayton Morris, longtime real estate investor. This show is devoted to helping you become a better real estate investor. So go ahead and subscribe to the channel and hit that little bell notification. That way you'll be notified as soon as we publish a brand new video. I thank you, and my co-host Grover thanks you as well. You know, for many people, real estate investing opens up a whole world to them. The idea of being able to have cash flowing rental property that's producing monthly cash flow every month would change lives, right? I know it changed my life and it could change yours, but money is the thing that's holding you back. You think, how can I come up with $40,000, $45,000 as a down payment on a rental property? I don't have that. I've got 5, I've got 10. Well, guess what? This is where the power of working with multiple friends and investors to buy that first rental property comes into play. If this has sparked your interest, then I'm about to blow your mind, because you may be saying, wait a second, I can buy real estate? I can invest in real estate, and it's not just me that has to do it? I can get a group of people together and we can do it? The answer is yes. If you're interested in buying rental property and you just don't have the money, this is where you could come together with other members of the real estate investing community, buy properties together, and now you get a piece and percentage of that cash flow and the tax benefits of owning that rental property, just because you found the right people to partner with. Now, the benefits of using this strategy are many. They're plentiful. Number one, it's great because you might not have the experience, the knowledge, and the history of a long time doing real estate investing. So you go to a meetup, you go to your local RIA meeting, and you meet some people who've been doing this for longer periods of time. You have some money, they have some money. Now you can lean more heavily on their expertise by identifying certain properties and putting your money into that group. You know, we don't live in a vacuum. We can't accomplish everything we want in our lives by ourselves. We always need a mentor, a guide, someone to help us along the way. You know, for me, I've surrounded myself with an incredible team. I don't do my own taxes. I don't do my own bookkeeping. I've got great people that I work with to get this done. And think about working and partnering with multiple investors as a way to start growing your portfolio. But there are different types of investors, so it's important to know the different roles that they might play. And there are 2 different types of real estate investors that you might partner with. The first is being an active real estate investor. That's what I am. I'm an active real estate investor because I'm actively looking for the properties, doing all of the legwork, finding the right property management companies, doing all of those pieces that provide a great experience when I have a property that I'm going to cash flow and place a tenant in that property. I'm doing all the work. I'm the active real estate investor. But you might find a doctor, a dentist, somebody who has a lot of money but does not have any time. They're in surgery all the time. They do have no time to be looking for great deals. And that is a second investor. That's the passive real estate investor. Grover, come here. In many ways, Grover is a passive family member because he sits around all day and just reaps the rewards of my love and my hard work. And that's honestly a great relationship too, because that doctor may have $100,000, $200,000 just sitting in an IRA that they're not using, but you as the active investor could help them leverage it. You're doing all the legwork, and they could get a much higher return on that investment than that money sitting in some bank account or some stock account or some IRA account. They can get a much higher return with real estate investing. There are 5 big advantages to buying a rental property with a partner. Let's go through all 5 of them right now. Number 1, the ability to raise funds as a real estate investor. That's right, you know, not everyone has money. Some people have time, some people have money. But you might find investors like the doctor, the lawyer, etc., who's too busy, has the extra money, but does not have the time. So that's how you can raise additional money, is from people that are looking to put their money into real estate, but they just don't have the time to do all the legwork to find a property. The second reason, it's easier to get funding from a bank when you've got multiple partners involved in the process. That's right. Banks look at that way more favorably because guess what? The risk is spread out over multiple individuals with varying credit scores and varying financial histories. When you have multiple partners that come together to buy a rental property, that bank is able to come in and give you much more favorable terms because of the multitude of players involved in that purchase. The third reason is it gives you an opportunity to focus on your strengths. I know what my strengths are and I know what my weaknesses are. You know, I'm not a financial person where I'm sitting there looking at spreadsheets every day. That's what my wife does really well. That's what my bookkeeper does really well. I don't. Spreadsheets make my eyes glaze over. For other people, they love them. I know what my strengths are and that's not it. So if you're in a relationship with 3 or 4 other investors, you're always going to find that certain member of that band, so to speak, that can play the drums better than the other person. And so you can lean on other people's strengths and they can fill in the gaps of your weaknesses. That's the beauty of having these relationships. And they should complement each other when you come together. The fourth benefit of coming together with other individuals is that it's a fast track of learning. That way you can come together with a group of individuals who've maybe been doing this for years longer than you have. It's like getting a free college course on real estate investing. By now you can call them friends, right? As you sit down once a month to talk about your portfolio and learn from them, bounce ideas off of them, you're now going to fast track your experience in real estate investing at a much stronger pace than if you just sat by yourself and never interacted with anyone. Now you have the knowledge base that you're able to gain from these partners that you're working with. And the fifth reason kind of goes with the fourth, but it gives you access to that group of friends, that group of investors, knowledge base, and network of individuals that they've been working with for years. So you might have a relationship with one of the members of your group that you're going to invest with, and guess what? That member may have a great bank that they've partnered with for many, many years. They may have a great contractor that they've been working with for many, many years. They have a great plumber that they've been working with. So, oh, I got that. I've got that taken care of. John is the best plumber. Don't even ask questions. We've got it. So you get access to all of these additional resources when you just humble yourself and say, you know what, I don't have all the answers. Now, there are some disadvantages to investing with other partners instead of just yourself, and I want to go through those as well. Number one on the list is you don't get to keep all the profits. I know that might seem obvious, but you're buying a property and the cash flow is $1,200 a month. You're not getting all $1,200 of that cash flow. And of course, the equity is going to be divided amongst the group as well. So if you've got a property that three of you went in on together, you're going to each own 33.333% of that equity in that property. Making sure that you have this figured out ahead of time is going to be incredibly important. Yeah, you can even hear Grover barking about it. He's not a fan of having to divide up the equity in a property with his other dog buddies, 33%. You know, if he's got 33% and three other people are investing with him, they all get 33%. Oh, he wants the full equity in that property. I understand that's why he's barking and upset. But just remember that this helps you grow your portfolio much more quickly. But the beauty is you're not having to come out of your pocket with a huge sum of money. You're able to only put in a fraction, a third of what you would have to put in if the property was being bought 100% by you. The second thing you want to look out for if you're investing with friends or partners is that there can be conflicting strategies about your goals here. So please make sure you sit down ahead of time and all be on the same page with what you want to accomplish. Make sure that, are you investing in single family homes, duplexes, and have that strategy. So there's no confusion that maybe on the second or third property, suddenly we're hopping over to self-storage units. We're going to be investing in mobile home parks next. Stick with the strategy, make sure you're all on the same page, and make sure that you stick with it so that when repairs present themselves in a property, or maybe the option of raising the rent on the property, you're all on the same page. Hey, remember that meeting that we had? That we're not going to put too many upgrades in this property. We're not going to raise rent beyond this amount. Be on the page ahead of time. That'll save you headaches down the road. Third thing to look out for is what happens if an investor just disappears. You formed an LLC together and one of those partners just disappears. That's why you want to make sure that you have a great legal team that you're working with that can take care of all of these things at the beginning, so that what happens if someone leaves and doesn't show up? Then the other two partners are able to take over in that person's stead. That person just disappears to Venezuela, and now you are left holding the bag. All of these things can be written out in your LLC agreement when you're forming your business, and it can be done very inexpensively, but just do it on the front end because circumstances can change. Your friend John might have been really into real estate investing, but then he might have had some life event that totally took him away from that. That's going to happen to some people. So please plan for that ahead of time. So how do you buy multiple properties with investors? Well, step one in this process, you want to find investors. I know it might sound obvious, but it's not so easy for some people. You can go to meetup groups. A very simple thing to do. Go to meetup.com and look for other investors and other meetups that are happening in your backyard. They're all over the place. Now, I know in the age of COVID, we had gone remote or we've done Zoom meetups and things like that. But see if you can still get together with different real estate meetup groups at the local pub or whatever, social safe distancing if it's allowed and if it's taking place. So that would be my first step, is to go to meetup.com. I've gone to many, many different meetup groups. They're a great resource. You're going to meet lenders, you're going to meet contractors, you're going to meet wholesalers, you're going to meet builders, all in one room, having a cocktail, or put on a name badge. Don't be a fly on the wall. You're there to make friends. You're there to find other people who want to invest. Start mingling. Start taking people's business cards, writing down notes, and following up with those people. Hey, John, it was great meeting you last night at that real estate meetup group. I'd love to have coffee with you and talk more about how we can start maybe partnering on some deals. Boom. That's how it starts. Another great resource is if you know someone that has an IRA, someone that has a traditional IRA, a Roth IRA, just sitting there really making no money at all in some terrible stock vehicle. What if you borrowed and partnered with them? Hey, Uncle Ken, I know you've got that IRA that's been sitting there for years doing nothing. How would you like to lend me money? I'll do the legwork on finding the property. You can be a passive investor. And guess what? We'll split the profits. I'll find the property. Your IRA can invest in the real estate itself. That's something that we teach people to do at Morris Invest. We help people with their IRA buy real estate all the time. And we have multiple partners that come together to do it. And we can even use funding on top of the IRA to help make this big, nice pizza come together for you. The second thing you want to do is thoroughly vet the person you're going to work with. And there are a couple of things that I would definitely pay attention to when you're looking at a potential partner. After all, you don't know this person for many, many years. You want to make sure that certain things are in place to protect you down the line. What are their partnership expectations? Do they want a daily phone call with you to go over your properties, or do they want to be more hands-off? And how often do they want to get together? It's a very good discussion to have up front. Another question you want to ask is, well, what kind of contractor expectations do you have? Like, how flexible are you to shop around? Are you pretty set on a certain group of contractors that you use? Are you open to finding a different painter? Or you've been using this painter for years? Are you flexible on that? One of the more important questions you can ask is about property management. I absolutely don't think that you should be managing properties yourself. That is another job, and property managers are set up for success for doing this for years. We look at property managers and vet them very seriously at our company. We want to know that they have over 5 years of experience managing properties. They use great software. They communicate well. How do they screen their tenants? What kind of background checks do they do? All of those things. So I'd have that discussion with your partner up front. If they're thinking that, hey, we're going to manage these properties ourselves and save 8 to 10% on property management fees, I want you to say to them, no, let's get a proper property management company managing our properties. We do not want to create another job for ourselves. One of the more difficult questions you might have is around the contract. Yes, you're friends, that's great, but after all, you need to put pen to paper. I've seen relationships go south more times than I can count. Not saying that's going to happen to you, but you want to put these things down on paper. Gauge their response. You don't want to just do this verbally. If they have a problem with setting up a proper LLC and framework and partnership and having it written down, might not be a good fit for you. And finally, a big question you want to ask them is, what are their financial resources? Do they have more than just one bucket of cash? We're going to do this first property together. That's great, but do you have an open round of cash coming in on a regular basis that we can work together? So that'll give you a frame of reference for how quickly you can grow that portfolio. The third most important thing when you're finding partners is to find out if everyone has their funding ready to go. A lot of people can talk a big game that, oh, I've got money, but you find out it's not liquid. It's tied up somewhere. And if you find a great property, you have to be ready to pounce. So does one of your partners have a home equity line of credit that they have access to immediately, which is a great funding source? We also work with Fund and Grow. We have a link on our website at Morris Invest that lets you get 0% interest credit with Fund and Grow. Just go to our funding tab at morrisinvest.com/funding. Do they have cash in an IRA? Do they have cash on hand? Or are they tied up in the stock market? How quickly can they liquidate some of these funds? Or is their money tied up in other real estate? So all of these questions are important up front. If we have a house, how quickly can we close on that house? The next thing that you want to put in place when you're finding your investors is an LLC structure or some kind of legal entity. So it's best to ask the question first, hey guys, what kind of legal entity do we want to have together when we're coming together in this partnership? Now, our accountants and lawyers always recommend an LLC partnership, and we work with a great team over at Corporate Direct. So if you go to our website, again, morrisinvest.com/LLC, we've got all of the resources there for you. We work with Garrett Sutton and the team at Corporate Direct because Garrett Sutton is Robert Kiyosaki's attorney. He's excellent. So again, if you go to morrisinvest.com/LLC, you can be connected with them and get an LLC set up in no time. and let them know how you want this set up. And they will give you the best advice from a lawyer perspective for very inexpensive to get this thing structured. There are different ways you can do it. You can set up an S Corp, you can do different partnerships within the LLC, but have that conversation up front. That way, again, if one of your partners has a family issue and decides to leave and becomes a MIA, what will that look like for the remaining 3 partners? All of these questions can be answered up front. Step 5 in this process, I mentioned it a little bit in step 4, but you want to make sure you have a lawyer drafting this up. You don't want to try to do this yourself, because that could come back to bite you in the butt later on. Use a proper company, use a proper lawyer that can structure a partnership LLC so that you can invest in real estate together. Do it right. It's not going to cost you a lot. Plus, it's a business expense for your newly formed business, and it's a tax write-off at the end of the day. Step 6 in this process is to find a great market. Now, you can work with a full-service rental real estate company like ours, where we spend years analyzing markets before we build our new construction properties and place our tenants in there for our clients. So you can book a call with our team at Morris Invest if you're interested. You can also do this yourself, and that's where the legwork comes in. So what you want to do before you even sink your teeth into a market is spend a long time doing the research and making the connections to find out if you're investing in the proper market. We've got a full checklist video that shows you step by step the strategy and tactics we use at our company when we're vetting a new rental market. I want you to watch that video. It's in the description below. We'll also link it up here in this card right up here. You can click that and check that video out as well. But before we go into any rental market, there are a number of things that you want to look for. I'll give you the high level, and you can go deeper in that video that I just mentioned. Number 1, we want to look at crime. We want to see that crime is on the decline. Number 2, if we're doing this ourselves, we want to look at job growth. Are jobs coming to this area, and Fortune 500 companies, et cetera. For instance, in our Texas market where we build our new construction properties and some of our other markets, we're seeing jobs after jobs after jobs coming in there. That means greater tax base. That means more demand for our rental properties. That means appreciation for the properties we already have. It's all around great to see jobs coming to an area. The other thing we look at is we want to make sure there's a multitude, a diversity of jobs, not just one source. We don't want to see just a super Walmart or one oil refinery. We want to see multiple companies that provide a diversity of jobs, from universities to healthcare, all manner in between. Another thing that we want to look at is appreciation. So on our properties recently, it's been great. Our properties we've been selling to our clients, and then the appraisals are coming back even higher than what they're buying them for. So they're actually getting built-in automatic equity on their properties, which is fantastic. So I want to see nice appreciation in a market, not crazy San Francisco appreciation, where it's like bubble territory. No, I want to see boring, nice, steady appreciation that's a hedge against inflation in the economy. That should be important. I also want to look at vacancy rates in this market. If I have a tenant turnover in the property, can my property manager fill it quickly? What is the demand for those vacancies? I want to look at property taxes. You should check out my other video on property taxes, but if property taxes are a little bit higher than what you might see in some cheaper markets, that might be great. Higher property taxes can often mean better school districts. That can mean longer term tenants. So yes, you might be paying a little bit more in property taxes, but guess what? You're going to save a boatload of money because you're not going to have as many tenant turnovers to have to worry about. And paint jobs and new carpeting and repairs, that tenant might stay 5-6 years because it's a great school district, a great neighborhood. Yes, you'll pay a little bit more in property taxes, but that all comes out in the wash. So those are just a few examples of the things we're looking for in a market before we invest. Again, check out our full checklist video on what we look for in our markets down below or in that card up here. Grab it. Grover, do you see that card? Where is that card? I can never know where it is on the screen. Number 7 on our list is you got to move forward with actually buying the property. Stop fooling around, get it under contract, and make the purchase. Step 8, if you bought a property that needs work, now is the time when you're going to have to implement your rehab strategy. Now, I hope that you had meetings early on with these potential partners to say, what is our plan, guys and girls? Are we just doing paint in this property? Are we looking for properties that don't need a ton of work? So we're going to maybe do some new carpeting, paint, or maybe update some appliances, and then we're good to go? Or are we doing a full gut rehab? Make sure you have those discussions ahead of time and have a consistent strategy. For me, I like to buy properties these days, new construction, brand new appliances that commands a much higher level of rent, and my tenants tend to stay a long time. So that's what I buy. What about you? What is your strategy? Are you looking for ugly ducklings in the neighborhood that need a lot of work? Or lipstick on a pig? You found one that just needs some paint and carpet? Or are you going to buy new construction from a full service provider? Whatever it is, have that discussion ahead of time. But now is the time, now that you own that property, you've got to start that renovation work. The clock starts ticking because you want to get to as quickly as you can to cash flow. And the longer that you don't have a plan, the longer it is until you get cash flow from a tenant in that property. Step 9 is to get this property rented out. Again, finding a great property management company. I hope you have done this before you closed on the property. Had discussions with multiple property management companies in a market. Make sure you use the criteria that we do when we are vetting property managers in our different markets for our clients. Make sure that they've been in business for at least 5 years. You want to find out that they're not managing too many doors that would lead them to be spread too thin. Make sure that they have good software that can manage your portfolio so you can log in, you can see your leases, your cash flow right there inside of an easy to use portal like AppFolio or something else. You want to find out how do they communicate with their clients. When you send an email, do you get an email back within 24 hours? If you call them, will they call you back or they answer the phone? Have those discussions. How do they screen the tenants? What type of background checks, what the credit score will look like for the tenants. All of these things are important, but have those discussions ahead of time. Don't start searching for a property manager to place a tenant after your renovation is complete. Now this renovation is complete, now you're going to start marketing the property or finding a property manager. Don't do it. Do it ahead of time. I would love to hear your thoughts about expanding your portfolio by investing with multiple partners. Please leave me a comment below on what your thoughts are. And subscribe to the channel. If you're new here, subscribe. We publish our videos multiple times per week. And make sure you hit that little bell notification so you'll be notified when we publish a new video. I want you to take a deep dive now and go through our checklist video to see all of the things that we look for when we're investing in a new real estate market. Check that video out below or in the card above. We'll see you next time, everyone.